Hello, everyone. Um, Actually, I've been asked to speak on this topic, Fintech, since all of you guys are budding Fintech entrepreneurs. I will have a few words to say about GHL towards the end, but let me take you through my reading of how this whole area is evolving. Having been a banker for half my career and the other half in payments, I think I have a balance between the both. Okay, very simple picture. Banks do a lot of things these days, but if you boil it down, there are four distinct things that all banks do. They perform credit risk intermediation, i.e., they take money from a depositor and they lend it to a borrower. They do value transfers, effectively payments, handling the settlement risk. They do market risk intermediation. This is where a buyer or seller sells equity or debt instruments or foreign exchange. And the banks handle the risk in between. And of course, they perform fiduciary functions like investment management, where they provide investment advice. Sometimes they invest in a discretionary mode. This has been going on for centuries, since the first Venetians bankers started operating. And pretty much nothing really changed until the onset of the internet, which allowed a whole bunch of people to have access to information that they would not ordinarily have. Also, with the advent of technology, people started using technology in very clever ways. The times are really changing. And let me show you how it's beginning to affect each component of the bank. Let's start with the first block, which is credit risk intermediation. Classical banking. Bankers lend typically in one of three ways. They either do name lending, i.e. they look at the person, they look at the company, they assess them on typically the 5 C's: capacity, capital, collateral, your conditions, your loan conditions, and the character of the person. Then they do a write-up, they do KYC, which is know your customer, they do analysis, and then they make a judgment call. Is this guy good? $5 million, $10 million, or 50,000? Whatever. And they move on. Over and above that, they sometimes undertake asset-based lending. This is when they lend against a car or a house, and they look at things like the asset residual value, loss norms, how much I'm going to do a portfolio, 50 million, I expect to lose 50 basis points on this over 2 years. They look at the vintage, certain years produce better results than others, and so forth. And similarly for portfolio lending, mortgages, credit cards, a whole bunch of things where you have a program to go out and lend a block of money under certain acceptance criteria and under acceptable loss norms. This is 101 banking for many, many years. What's happened is that there's a whole bunch of new companies coming up, fintech companies, that are the Turks. They are looking at things very differently. Their value proposition is simply this: I will give you a higher return. My origination cost is going to be a hell of a lot lower than what you're going to get from your bank. So if you want to borrow money, I'm not going to ask you to fill in 50 forms, go to a lawyer, and stuff like that. I'm going to do it quite quickly and simply for you. And of course, in terms of flexibility, investors can, lend money, and once they lend money, it's almost securitizable. They can actually sell that loan to somebody else on the net, or they can wait till the loan is repaid. So that kind of power is immense. And these companies typically target smaller ticket items. There's absolutely no relationship between the lender and the borrower. They meet online. The risk model of the provider basically tells them, I've used my risk model, this is what it looks like. You pay your money and you make your choice. And it's caveat emptor. So in one sweep, what these companies have done is they've stepped out of the traditional role of banks and said, I am not going to underwrite it. I'm going to give you guidance, but you make the call. And you, the lender, decide who you'd want to lend money to based on the parameters that I've set for you. That's quite fundamental. That's allowed these companies to reach into a much smaller market, which the banks could never go to, and lend for shorter durations too. You know, it's very hard to go to a banker and say, hey, listen, I just need a 30-day loan. He'll still ask you to fill in a whole bunch of forms and stuff. Banks can't operate that way. And these fintech companies have found that sweet spot, and they've gone in. And they're not small. Lending Club has loaned out something like $16 billion US. That's huge. All right? And I think the second largest, Prosper, is a lot smaller. It's about $3 billion. Not trivial. It seems to be catching on. I think in Malaysia, there'll be at least 3 or 4 coming out by the end of the year. So we'll begin to see how these companies coexist within the ecosystem. Ironically, even in places like Australia, you'll find that banks are starting to participate in this kind of deal. You know, like factoring deals. Rather than they do it themselves, they look at the criteria and they say, no, not bad. Maybe I'll stick in $5 million as a lender into this fintech company and then take my money out 60 days later. Lots of exciting things happening here, and a great deal of disruption is occurring. And this is happening throughout the US, and I think it will sweep right through Asia. Certainly it's huge in China. So that's on the core lending part. Let me touch a little on value transfers or payments. I run a payments company, and this aspect is close to my heart. I'm going to spend a little bit more time in this area because it's complicated, and a lot of different people have done different things, and it's interesting to see how they're approaching it. Let's start with simple examples of consumer-to-consumer payments. All of these companies allow that, and some of them are giants, PayPal and Alipay and Google Wallet. These companies are huge. Facebook, obviously. And all of them started life allowing individuals to make payments to each other. Banks are now trying to get into it. Citibank has OboPay, DBS launched something like PayLah, and I think you'll find equivalents all over Asia. These companies are producing solutions other than the traditional payment devices, payment products like Visa, MasterCard, or Bank Gyro, and they are exuding tremendous marketing skills and knowledge. I will share a little bit more about Alipay, which I think deserves special mention here. Clearly, they're able to manage the risk and gain the trust of the consumers. The last category below, digital currency is it's a very interesting area, and probably, if I had to say, I would say the most innovative thought in payments in the last 2 decades is the blockchain technology. And there, it basically substitutes a currency for something that's purely digital. But it does assist consumers make instant payments across vast distances. Typically, for instance, if you were living in India, you know, where the infrastructure isn't as good as elsewhere, and your kid was living in the United States, and suddenly the kid had to send his parents some money urgently. To do a wire transfer requires a huge amount of paperwork and requires people to travel to a physical bank to get their money. Alternatively, you could fire the guy the kid in the US could send money through bitcoins, which would arrive in seconds, and the parent could exchange it through a Bitcoin exchange and put the money in a bank account in India and receive it next day or the same day. So the power of that kind of disintermediation, cutting through the red tape, moving money quickly, I think will remain valuable, particularly in countries like Philippines, Indonesia, India, and so forth, where, you know, it's not that easy sometimes to get to a bank or an ATM. Quick word on Bitcoins for those who don't know. It's purely digital. Unlike fiat currencies, there isn't a central banker who signs a piece of paper and prints money. Bitcoins prints money through an algorithm which is predetermined. For Bitcoins, there can only be 21 million Bitcoins ever issued, and they fall down in super small denominations, the smallest of which is a Satoshi. It's a completely open system, unlike fiat currencies, which is controlled by the central government worldwide, and it's completely transparent. Now, these are all virtues that we cherish in the internet. You know, I like open systems. I like dealing in an environment that's purely transparent. I don't like somebody grabbing me and saying, oh, no, you can't download this, you can't do that, because that's so uncool. And this is the power of the Bitcoin. It's faltered recently because the US dollar gained strength, and people have shied away from using it as a safety currency, I guess. But it has its uses for those places that are hard to reach. Blockchain technology, which is the technology underlying Bitcoin, is even more interesting. A lot of the companies that I had talked to, in fact, we were trying to bring Bitcoins into Malaysia, but these companies have now evolved. Rather than selling Bitcoins or exchanging Bitcoins, they have now evolved into using the blockchain technology to transport a huge number of things. Here are some examples of what's actually happening. This NASDAQ link, there was a company called Chain.com, and it was the first company to issue shares to a private company. This happened in December 2015. R3 Alliance is basically a group of big banks that are allowing interbank transfers. Again, it cuts out the trusted middleman. I mean, typically today, in an underdeveloped country, you give your money to someone, and then he somehow makes sure that the money reaches whoever you want to send it to in another country. That someone could be a Western Union, or it could be the money changer, you know? But systems like this just cut out the middleman, make it completely transparent. Distributed ledger systems, even Visa and MasterCard are investing in it. Think about this. Today, every Visa card or MasterCard transaction that is processed goes through a huge clearing and settlement system. There are these mega data centers that basically analyze and clear the transaction and decide how much goes to the issuing bank and how much goes to the acquiring bank and how much goes to Visa or MasterCard. These things cost money, and they add to the transfer cost. Under blockchain technology, this is done for free. Yeah, free. So the person who does the processing gets paid through the issuance of Bitcoins. Sorry, excuse me. And similarly for insurance. Because the premiums are paid by the end buyer, you have, you absolutely know the customer, you know who the end buyer is, no games. Sorry. If you look at retail payments, I think the approach has been somewhat different. The new companies, you look at Square in particular, it's a $3 billion company. It processes about $6 billion US dollars worth of transactions a year. PayPal, of course, is huge, 46 billion, and it processes about 120 billion, I think. And you have iZettle, which is a European version. And even companies like GHL, we have our own airports, Stripe, SmartPay, and so forth. What do these companies do? They're using basic mobile phone technology, something that can link with the mobile phone either through a Bluetooth or plugged in. But the approach is different. They're targeting an underserved market segment. And because these segments are underserved, they're able to grow quite rapidly. Let me give you an illustration of what I mean. In ASEAN, over 90% of the market is underserved. In fact, 90% is Malaysia's number. If I add in Indonesia and Philippines, it's high 90s that is underserved. That triangle there shows you the distribution of companies in Malaysia by turnover size. So for tier 1 companies, which are the largest companies, They have a turnover of more than 200 million ringgit. There are about 3,000 companies here in Malaysia. And at the bottom of the rung, tier 4, 510,000 companies, they have a turnover of less than 12 million ringgit. 12 million ringgit is about, what, 3 million US, right? Rough and cut. Now, if you do the same triangle in every country in ASEAN, you would find a triangle. It would either be a thinner triangle or a fatter triangle. In Singapore, it would be a thinner triangle. In Philippines, it would be a much fatter triangle, and so forth. Point is this: the dark blue areas that are shaded out, i.e. the lower half of tier 3 and the whole of tier 4, is totally not served by the banks. The transaction throughput is too small, the banks don't make money, and they've never ever entered there. This simple mathematical distribution created every single company that I showed you in the slide earlier. In the United States, Square walked in and delivered 7 to 8 million new devices. And if someone had said, maybe 6, 7 years ago that, there is an opportunity to put out another 6 to 7 million devices in the United States, most people would have thought that that would be crazy. But that's exactly what they did, and it's because of that blue shaded spot. And how do you do this? Well, the players, if the banks are not going to do it, other people have to, and this is where companies like Square and even GHL come in. We need to underwrite the merchant risk. Under a TPA model, what happens is that the TPA, in this case GHL, would acquire merchants directly. In other words, the contracts will be signed directly between the merchants and us. And there would be a back-to-back arrangement with an acquiring bank. Now, herein lies the rub. The merchant performance risk stops with GHL as the TPA. So if for whatever reason the merchant takes money from a consumer and then defaults in his performance, then the acquiring bank will look to GHL to make good any losses, any chargeback losses or any other losses that may have been incurred. So to attack this segment, you need to build a risk management competency that is significant and different from the banks. It's no point building a risk management competency that's similar to the banks, because the banks are not looking in the tier 4 segment. They're looking at the bigger ones, tier 1, 2, and 3. So this is what we had to do. We built something fundamentally different, as did Square, as did Zettle, and as did everybody else. The approach was different. Square is very, very heavily algorithmic. Ours is quasi-banking and algorithms, both. So everyone has his own recipe, and the proof of the pudding is your loss norms, ultimately. Okay, so the other skill that we had to grow is we had to move from consultative selling. Our customers are every single bank in Philippines, Thailand, and Malaysia, big banks. So we had guys out there who, well, they didn't quite put on suits, but they would sit there with the banks and understand their issues and find solutions. So we had to build a new bunch of people that didn't have to do that. And these people would be what I loosely call hairbrush salesmen. They'd go out there and say, this is my hairbrush, this is what it looks like, this is what it does, this is what it costs, it's better than the next guy's hairbrush, why don't you buy 2? And then we had to get about 200 of them in each country and manage them through a process. And that required some learning. Risks I've spoken about, and of course we needed to automate and make it easier. What do I mean by that? We had to rethink how we approach the implementation. We couldn't send people out there each and every time to put out a terminal or a device. We had to get rid of every single piece of paper. So the engineers were given tablets, everybody communicated through tablets, the paper disappeared, software was just shot through the wire into the terminals, terminals were mailed out, call centers were used to educate and train them. The thinking process was completely different. The approach was very different. The cost structures changed. The customer experience had to be maintained, which is very challenging. We're still learning, and we're getting better and better at it. Huge transformations. But through these transformations, we are able to disrupt that entire bottom part of the pyramid and take our fair share of what is rightfully ours. I said I wanted to spend a few minutes on China. In terms of success, especially in payments, you cannot but not talk about China. They moved from traditional mobile phones, this is particularly for mobile phone payments, where they had simple things like SMSs and call centers, to 2007, where suddenly the smartphones became more interactive, you could buy movie tickets and so forth, until 2014, when really, between Alipay and Tencent, the power of the wallet came to the fore. If you look at that table there, electronic payments volume totaled about 16 trillion US dollars last year, of which almost 50% was through the internet channel. That 16 trillion excludes the bank. So it's just purely China UnionPay, Alipay, and the likes of companies like that. The question is, how the hell did they get there so quickly? Right? What did they do differently? And let me show you some examples of how they've executed. Number one, through the wallet, they made it very, very easy for the consumer to use. You could top up the wallet in many, many ways. You could go to a store and pay cash and top it up. You could use your credit card, debit card, gyro, you name it. Any payment device you could use to top up your wallet. Today, if you want to put money into your bank account, your physical bank account, you would have to basically gyro it, write a check, or actually go to the bank and put in money. You could do all of this by tapping buttons on your phone without moving from your chair. That was a significant value proposition. The second thing that they did, and they really were gutsy about this, they went out and said to the Chinese, take your money out of your bank and put it into my wallet because I am going to pay you a higher rate of interest than your bank. And they did that. They paid them a higher rate of interest. They developed an app where you could see the interest earned on your money flicking away by the second. And the Chinese were hooked. They were totally hooked. The guy pulled out like $500 million, threw it in there in marketing dollars and said, I'm going to take it. The bank screamed, ran to the regulator and said, he's deposit taking. So they bought a bank. Alibaba bought a bank and said, we're a bank now. All right? So such immense power, it requires a lot of guts for a company to stand up there and in 7 years say, this is going to be mine, and I'm going to take a big risk. So I take my hat off to them. I really do take my hat off to them. Between that war between Alipay and Tencent, this is what happened. How can the wallet be used? Again, it can be used in so many different ways. You have QR code, SMS, NFC, web. You can go to a little village and you'll have these tables. This woman will sell dried fish in piles, right? And there'll be a QR code in front. And if you want to buy, you point there, she'll put a little bit in a plastic bag, and then you take your phone out, you click on the QR code, and you just paid for it. Right? She's got nothing. She's got no EDC. She's got no electricity. She's got nothing. But there, a transaction just occurred. That's a QR code. You can do the same thing with NSE, tap. You can do it on the web, obviously, online, and SMS. So they make it easy for the consumer. How many ways can you pay with your plastic credit card? Insert, swipe, and now maybe if you've got PayPass, you can use PayPass and tap. But this is far superior. Of course, you can do interbank funds transfers as well. And this is the other thing about being open. Alipay really thinks like an internet company first and a payment company second. That's really, really important. So they built this wallet, and then, just like iTunes, they allowed everybody to come in and said, go ahead, build whatever app you want. So today there are apps that deal with mobile phone recharge, booking for your taxis, your trains, you name it, it's there. Okay, so the apps there that totally link into the wallet. So suddenly now, you have a phone, you've got a wallet, and you can do all these things with your phone. You don't have to pull out your card, you don't have to go somewhere to do something, to make a payment. I didn't get this until I asked my staff who are working in China how they pay, and they said all of them pay using Alipay. And I went, that's crazy. Why are you doing that? You know, you've got a China Union Pay card in your wallet. He says, yeah, but it's a drag. I got to pull it out of my wallet, and then I got to, you know, why the hell do I want to do that? Anyway, they're paying me more. My salary goes into my Alipay wallet. And I'm like, oh, okay. There's something strange here. Okay, so this, I think, is probably the leading example of fintech gone crazy and successful. I can't see anybody even close to that. The Japanese were here years before the Chinese, but the Chinese have just overtaken the Japanese and gone ahead. What Apple, Google, PayPal are trying to do will be some of these things. And they will probably do it quite well. But they're still quite a way behind because of the consumer acceptance. All right, I'm just going to have a few words to say on the last two segments, which is market risk and investment management. A few interesting things happening. In terms of investment management, certainly, you see this concept of robo-advisors. This gives you a snapshot of what is happening, I think it was by the end of last year, in the United States. And basically what it is you don't talk to a human being anymore when you want to make an investment decision. You go online, and there is a robot that has pretty powerful algorithms behind him that kind of tells him what you want to do based on certain questions he's asked you. And people are beginning to gravitate towards this. It's still very small. If you look at it, it's about 13 billion US dollars funds under assets under management. It's tiny. But I don't know. The verdict is not yet out. Let's see how this goes. My sense is it will grow quite a bit. I had a peek in China to see what the Chinese were doing. And this is what I saw. There today, online wealth management is about 2 trillion renminbi, and according to some estimates, it will grow to 10 trillion renminbi by 2020. And if you look at the key guys, Alibaba and Tencent, if you look at the coverage they have, they've basically nailed it. They're in insurance, they're in brokerage, they're in asset management, they're there. And of course, in the banking activities, they basically are there in a very big way. The reason why I think they are so successful is, firstly, because they have that massive consumer base, 400 million, 800 million, according to Tencent. They have that power, that huge base, which gives them a big stick to move the market. And secondly, they're really gutsy in terms of the way they do business, the risk they take sometimes, and the, can do, never die kind of attitude that says, I want it all. And I haven't seen that in a long while, and I think that based on their past, I suspect that they will be quite successful in some of these fintech ventures going forward. I think that's pretty much all I have to share with you. I'd just like to conclude by saying that at GHL, we view fintech very seriously. We are a leading provider of physical online terminals. We also have physical terminals, card-present terminals. We also have an online presence in the countries in which we operate. I think Ang explained very clearly how that business operates. We operate in exactly the same way. We're huge in Philippines. We're number one. We do 1 out of 3 terminals in Philippines is managed by us. 2.5 out of 10 in Malaysia is ours, and so forth. So we have that base, and I think that is a strength, because just like in the case of Alipay and Tencent, ultimately, I don't think these terminals will exist. I think these terminals will go the way of the vinyl record. Some of you can't even remember what that is. But I think an EDC terminal is gone. I think it's over. It might take a longer period in countries like in Asia because of the poor infrastructure, but give it 15 years, it's gone. And I think what will replace it eventually would be wallets, and powerful thinkers who can differentiate the business model. It's going to be very challenging for companies, unless Visa and MasterCard radically change their organizations. It's going to be very, very, very challenging for these companies to think and behave like the new wallet issuers, like a PayPal or a Alipay or so forth. Because they are nimble, they're on their feet, they're like ballerinas dancing very, very quickly. And it's hard for huge companies to deal with it. As far as we are concerned, we are looking out for these fintech companies because we know that one day it'll go, and we'd rather cannibalize ourselves rather than let somebody else do that for us. Thank you very much. So, literally, thank you very much. I'm done.